we've got an image of a happy scarecrow there for you, because if you look at the studies that have been done on home security services, 60% of burglars surveyed, this is real, 60% of burglars surveyed said that if it has an ADT sign outside, they're less likely to go in. Now, 50% said that if they do go in and they trigger an alarm, they're just going to stay and burglarize the house anyway. But 60% said the sign will make them go away. So the placebo effect here is, I think, better for consumers. If you're at home and you have an ADT security system, just go with the placebo effect. Put outside, it says, you can use my name. You can say AMI Security Systems, AMI Security. Just put a blue sign with that, and you don't have to pay $50 a month plus $30 a month to the local police and fire. And you certainly don't have to go into the market today and spend 30 times cash flow to buy a company that has like a one-time growth bump here because of a churn number and is showing you a fictitious churn line that, or it's a real churn line, but the rate of improvement is fictitious. And essentially asking you to bail out the current owners who bought this thing at a pricing of $6 to $7. They're selling it to you now at 19. We have 16 to 18 in here, but revised upward, even a better short after today, that it was revised up to 19 for the IPO. So they, in 20 months, they're getting a 3x improvement just on that churn rate improvement, which we showed you is mostly math. That's what's changed, is the math. And I mean, even if you cut this thing in half and you're buying this thing for $9.50, you're still paying 17 or 18 times free cash flow for this company on a clean basis, and you're still giving them the benefit of improvement of a year and a half of improvement of having owned the stock. So this is one of those things where it's so clear why people are going to get trapped in this. It's so clear why the CEO's folksy charm is like a hot knife on butter here for investors, where we're all sitting here going, oh, we love this story. We love new management coming in, and they know how to fix this business, and they're fixing this business. And look, they're really fixing this business, and I'm going to own this thing because, hey, well, everything else is picked over, right? We're late in the tech cycle. We're late in the equity cycle. Everything else is out there already. I'm going to go look and see if I can get an advantage with this piece of dung. Don't do it. Save yourself the trouble. This thing ends very badly. And it ends, by the way, so fast. Think about it. Out of the $2 billion that they're going to raise, $750 million will go to bailing out the Koch brothers. You should be the Koch brothers. You should be selling today on this IPO. The Koch brothers paid into this IPO, into this going private with $750 million, and they got a double-digit cash dividend and preferred securities out of it. That's what you should have done. And they're selling on this IPO. You shouldn't be buying. Don't go against Warren Buffett. Warren Buffett is selling this IPO. You're buying. You're a value buyer. You're trying to go against the Koch brothers. Good luck. And then you've got 85% of the company that's still going to be owned by a greedy private equity shop that has to get out. And you know that growth rates are peaking this year because of everything we just showed you. Growth rates are going to fall. No American company likes to forecast falling growth rates. They already told the sell side to model 4% for next year. They're going to have to make acquisitions to keep that going, which means they're not going to delever, and certainly the cash flow is not going to go to you. And if you're not going to get the cash flow, why else would you buy this thing? Leave it to somebody else. That's what I say. It's a short.